I'm Professor Indra Bisek. Let's look at what are secondary financial instruments. There are two types of financial instruments, primary and secondary. Under primary financial instruments, there are financial assets, financial liability, and equity. But when it comes to secondary or the derivatives, as commonly known, the secondary financial instruments tend to derive value from an underlying item. There are three types of derivatives or secondary financial instruments. First one is hedges, second one is options, the third is swaps. The hedge contracts, they all are contracts. All these financial, secondary financial instruments or the derivatives are in fact leads to contracts. So the first one, hedge contracts could be forward contracts or futures contracts. The options are rights. You can take a right to buy or sell or to convert. So to buy, for example, shares, to sell shares, or convert a loan into shares. They are options contracts. The swaps, on the other hand, they are contracts where one entity could exchange an attribute of an item. It could be a financial item, for example, a loan, and an attribute in that is interest rate. It could swap the interest rate type. For example, one entity could be exposed to fixed interest rates very much, and the other entity is very much exposed to variable interest rates. So the two entities, to reduce that exposure, they can exchange the interest rate types so that they pay each other the fixed interest rate to the variable interest rate exposed entity, and the variable interest rate exposed entity pays the variable interest rate to the fixed rate exposed entity. When we talk about secondary financial instruments or the derivatives, there are two things that becomes important. The first one is the concept called underlying item. The second one is the concept called underlying instrument. Underlying item could be any item. It could be the primary financial instrument or any other item, something like a commodity or a metal where there's a value in that. An underlying instrument is the name that is for used for the derivative. So there are three types of derivatives: hedge, option, swaps. Under hedge, there are two types of contracts: forward contract and futures contract. The forward contract is issued by a bank. In that contract, you lock in or agree to a price of the underlying item now for a future settlement date. For example, you have accounts receivable in foreign currency that you're going to receive in 3 months' time. You can go to the bank now and agree upon a conversion rate for the foreign currency you're supposed to receive, so that by that you become certain about the amount of foreign currency or the amount of local currency that you would obtain in return for the foreign currency. Futures contract, on the other hand, is done in the futures exchange. So very similar to forward contract, you lock in or agree to the price of the underlying item for an agreed quantity now for a future settlement. So it's about quantities. So often in futures contract, you deal with commodities and metals. For example, wheat, gold, and you can agree upon to an underlying item, in this instance, for example, wheat, for an agreed quantity, let's say about 1,000 tons of wheat, now for a future settlement, that is for a sale price. Options contract, on the other hand, are issued by a firm. A firm can issue an options contract, and the holder of the options contract can buy these rights. It can buy these rights of the options. It can buy the options. When it buys the option, it can buy the options to as right to buy something or right to sell something. Often this is applied for shares. So when options rights are being bought, when the right is to buy, it's called call option. When the right is to sell, it's called a put option. The swap contracts are again issued by firms. So if there are two firms and if there's a certain attribute of an underlying item, let's say the underlying item is loans, and one entity is heavily exposed to fixed interest rate loans, the other entity is heavily exposed to variable interest rate loans, and the entity that has fixed interest rate loans can agree with the other entity to swap the variable interest rates, and the entity that has exposure to variable interest rate loans can agree to swap for the fixed interest rate loans. So what happens is that the two entities are paying the interest rates or the interest amounts to one another for the exchange. By doing that, what it does is it is diversifying the loan portfolio without actually taking a diversified portfolio. The diversification occurs through these swap contracts. So let's say one entity has foreign currency accounts receivable. It can pre-agree to a price to sell foreign exchange at the settlement date, goes to a bank and enter into a forward contract. So that contract is a derivative. So that the agreement becomes a secondary financial instrument because that's going to derive value from the foreign currency of the accounts receivable. If an entity is having a diversified share portfolio, it can take a futures contract to ensure that the share portfolio value will be maintained by taking an ASX 200 futures that represents the diversified share portfolio. So the futures contract is entered with the futures exchange. If it is about wheat, for example, it can go and take a futures contract and enter in the futures exchange for the wheat futures. What's important here is that there are underlying items here. The forex accounts receivable, diversified share portfolio, wheat. They are underlying items. On the other hand, got the instruments that derive value from each of these underlying items. It could be the forex, the foreign exchange, the forward contract, the ASX 200 futures, wheat futures. All these are deriving values from the underlying item. They have a correlation between the underlying item and the underlying instrument. Stronger the correlation, the effectiveness of the instrument or the derivative or the secondary financial instrument becomes important and viable. One thing that we need to make a note of is that the hedge should be effective. Hedge is an investment strategy to minimize potential investment losses. The goal of taking a hedge by an organization is to manage different risk or the variability of the fluctuations. So the effectiveness of the hedge means that the hedge item variability or the fluctuation and the hedge instrument variability or the fluctuation is very close. It's between 80% and 120%. An effective hedge means it modifies the normal basis of recognizing gains and losses, the revenues and expenses of the hedging instrument. It's been matched with the hedge item of gains and losses in the same period. When it comes to measurement of secondary financial instruments, we need to recognize that secondary financial instruments is again a contract of financial assets and financial liability and equity. There are three types of secondary financial instruments: hedge, option, swap. So what does derivative do about the underlying item is the key focus here. In a hedge, it could be about the fair value. It wants to manage the fair value, or it wants to manage the cash flow, or it wants to manage the parent's net investment in the foreign operation because it is exposed to foreign currency. If it is managing the fair value of the hedge item, then any change that occurs in relation to the derivative will be recorded in the profit and loss statement. If it is about the cash flow, it's going to manage the cash flow, then the any variation, any fluctuation on the derivative will be recorded on other comprehensive income, and then it will flow to the cash flows reserve. Until the hedge items is recorded, it will be reserved in the cash flow reserve. And once it is recorded, then that cash flow reserve will be transferred to the underlying item, because the purpose of the hedge is to manage cash flow of the underlying item. If the hedge is taken to manage the parent's net investment in foreign operation, then it's about the foreign currency exposure, the fluctuation of the derivative will go into the other comprehensive income and then flow into foreign currency translation reserve. And it will get reclassified to profit or loss is when the hedged foreign operation is disposed of. If it is an options contract, and if the derivative is about the option, then the fluctuation of the option will be the fair value, and any fair value change will be recorded in the profit and loss statement or the income statement. If it is swap, the change in cash flows will be recorded as profit or loss in the income statement.